Hey there again. This is segment 2 for Unit 3, using the balance sheet and analyzing it. And let's jump into the content here that goes with this section. So we're going to be talking about in segment 2 here how to utilize the balance sheet for analysis. We often want to compare relative financial condition to different businesses and the same business over time. So you want to be able to know what's your business doing compared to other businesses, and that's one way to utilize the balance sheet. And you also want to take your balance sheet and hopefully be able to figure out, is your net worth growing over time, or is it falling, and then what do you do about it? It's just one piece of information that you'll utilize in assessing your financial condition. So of course, differences in business size can cause problems when evaluating positions. Large businesses can have the same serious liquidity and solvency issues that small businesses have. But we have to be able to measure and then identify the type of problem that we potentially have. So the way to do that is to utilize ratios, because then that takes the bias of size out of it. It kind of standardizes the analysis, and lenders use this a lot to make lending decisions because it tells them a little bit about risk, and it also helps them monitor financial progress of their customers or those that borrow money from them. So we're going to go through a number of different ratios here, and a couple of them we will practice through some financial reporting assessments in class, and a few others we won't use quite as much. So let's look at analyzing liquidity first. We're going to compare current assets and current liabilities, so sources of cash over the next year and needs for cash over the next year. And we consider that based upon, we can calculate a current ratio. So all you do to do that, very simple math, you just take current asset value and divide it by current liability value. If the ratio is 1.0, that means your assets equal your liability. So every dollar that you have in asset, whether it's cash or asset value currently, is already dedicated to paying off a liability somewhere. And so if you had to liquidate everything, you would have zero at the end. Basically no margin for error. So obviously the higher your current ratio is, the better. I put this slide back in for you to kind of practice going in and calculating a current ratio, and again use current assets divided by current liabilities, and just make sure that if you're going to practice here, use your cost basis on both of those, or market basis on both of those. So if you take $111,300 and then divide it by $88,620, just very easily on the calculator, you'll come up with a ratio of 1.25. That means there would be 25 cents left for every dollar of liability that you have. So the larger the ratio, the more liquid the business is. There's really no guideline for how high or how low. Just the higher the better. A banker isn't necessarily going to say you must be over 1.2 or 1.8. Each lending institution might have their own kind of metric as a guideline, but it's just generally how high can you be. The next metric that we'll look at is what we call working capital. So current assets minus current liabilities. So again, those dollars left after selling all your assets and paying all your liabilities. So again, it measures the available cash to make new purchases or pay your family living expenses, etc. So again, identified it as a dollar value, so therefore probably not going to be used in liquidity comparisons. Again, you could do this example here, taking 111,300, divide it by 88,620, or actually subtract it, excuse me, and you would have about $22,680 available in cash in working capital to do different things. So you have to make a decision on what to do with that money if you need to make any decision at all. The next one is analyzing solvency. So measuring the relative relations among assets, liquidities, or liabilities, and equity. So the range of accepted values here may really vary from lender to lender. And the main one that we're looking at here is what we call debt to asset ratio. So total liabilities divided by total assets, almost upside down from the current value, current ratio that we talked about, except we're also going to use total liabilities and total assets. So the value should be less than 1.0, and the lower it goes, the better. So again, a 1.0 would mean debts equal assets, equity is 0. Anything above 1.0 indicates insolvency and a business that is at risk. So if we go to, again, our balance sheet example that we're looking at here, and if I go cost basis, total liabilities, that one is $323,620. And if I divide that by total assets, which is $553,800, I'm going to get a I'm going to get a debt to asset ratio of 0.58. That indicates that we're in pretty good shape in terms of our debt load. The next one here is equity to asset ratio. So total equity divided by total assets. So it measures the part of the assets that are financed by owner equity. So how leveraged are you in some form or fashion? Kind of another way to look at that. So higher values are preferred, but the ratio can't be greater than 1.0. So insolvent businesses are going to have a negative equity to asset ratio. Again, be a red flag for a lending institution. I'll let you go ahead and calculate that one. We'll continue to move on. That one we won't use quite as much. The next one is a debt to equity ratio. So the total liabilities divided by owner equity. So it compares the proportion of financing provided by the lender with that provided by the business owner. So who is financing this operation? If a ratio is 1.0, the lender and the business owner are providing the same amount of financing. And the smaller the value, the better here. That's preferred. So large values result in small owner investment and increased chances of insolvency because that means the bank owns more of it. So again, if you go through your example here, you can pause the video and do your example calculation and check and see what that one is. We'll be practicing these again in some assessments in class. Some other measures are net capital ratio, total assets divided by total liabilities. Again, opposite from the debt calculator here. So the higher the value, the greater the solvency. So a ratio of 2.0 would mean liabilities are half of the assets and equal to equity. So kind of considered a minimum safe number. So a good one to kind of look at occasionally. Debt structure ratio, current liabilities divided by total liabilities. So the smaller the ratio, the better. So a large number means more cash is going to be needed to meet liabilities than might be available. So there's some things to look at there as well. Here's another example that, again, I'll let you pause the video if you want to go through and practice and study where these numbers are coming from. Then we're going to do a number of activities on Canvas and online and in the classroom that hopefully reinforce and help us teach you how to walk through and analyze a balance sheet and compare them. So a statement of owner equity, then, that balance sheet shows your financial position at a point in time, but not really changes over time. Those you would have to put multiple balance sheets together and probably build yourself an Excel spreadsheet to show yourself a trend line. So owner equity statements reflect these changes and the amount from each source. That's going to wrap up segment 2 here of our video. And some take-home messages here that as we walk away is it's important to think about that it's it's important in the financial analysis of your business that you understand how to utilize these metrics. Your lending institutions and also just knowing how to analyze your own business, whether it's an agribusiness or your farm business, it's important to know where you stand financially and where you're headed. That balance sheet is going to be a key piece in making those analytics and therefore then making good decisions for your farm business. Thanks for tuning into this video.